Hi, I'm Karen Ward.
And I'm Hugh Gimber. Welcome to JP Morgan Asset Management's Markets Explained.
Your weekly briefing, where we cut through the noise and focus on what matters most for investors, setting you up for the week ahead.
Okay, welcome back everyone. It is Monday the 20th of July. Karen's still on her holes, hopefully having a lovely time. And so today I've got another special guest with me to go through everything that's been going on. Callum Abbot, our UK equity portfolio manager, head of systematic active core, and more recently dabbling in some global equity funds as well. So Callum, I think you're really well placed to walk us through global markets this morning. Thanks very much for joining us.
Hi Hugh, thank you very much for having me.
Plenty for us to get through. I think in terms of the plan, we'll start briefly by touching on last week's data and then obviously the escalation that we're seeing in energy markets as a result of the conflict in the Middle East flaring up again over the weekend. But then, Callum, it's obviously no coincidence that you're here today, given your UK specialism. We have Andy Burnham soon to be taking office. I think worth saying for listeners, we're recording this just after 9 a.m. on Monday morning. And so we'll obviously be following closely as we learn more about the cabinet picks over the course of the day and the various speeches coming up. And then at the end of today's podcast, I do just want to touch on the ECB briefly as well, because for me, that's the main event in terms of macro data this week with the ECB meeting this Thursday. So Callum, when I look at last week's data, to me, it all feels quite quickly stale. We had a soft US inflation print that was welcomed by the market. We had Chinese GDP data, which was pretty weak as well, still clearly a two-track economy for China with domestic weakness being offset by export strength. But obviously over the weekend, we've seen another big move in oil prices. We're now back above $90 a barrel, and yet equity markets really basically continue to shrug this off. It feels like we're in something of a tug of war at the moment with the macro picture gradually deteriorating, but then a swathe of strong earnings results offering some optimism about solid corporate fundamentals. So, in your seat, what's catching your eye at the moment in terms of how you put those two together?
Yeah, absolutely. I think on the energy side of things, it's, as we know, incredibly difficult to forecast. So for our funds, we really try not to take much of a view either way, try to keep that quite balanced. I think at the moment, everyone's quite relaxed because we're not quite breaching levels where people are really worried. However, if this persists, I think what you're going to start to see is things like inventory drawdowns, which are going to start driving up bills for consumers considerably, particularly if we really hit low inventory levels in Europe. Then you're going to see that start to impact fiscal budgets. You're going to start to see yields go up quite considerably, and that could push things to a level where it's no longer tolerable and does have a meaningful impact on markets.
Definitely. I'd say that's pretty consistent with how we're seeing things in the market insights team as well. In our mid-year, we had a range for oil prices of $80 to $90 a barrel at year end. So obviously we're right at the top end of that range this morning, but still within those sort of manageable levels. But obviously we'll be watching carefully with very little ability to forecast where this goes over the next week or two. In terms of those earnings reports, I mean, bluntly, it's been a booming start to earnings season in terms of what corporates have been telling us. We had the banks last week delivering broadly strong numbers. We also had some pretty strong data from the semis names, some in Asia, some in Europe, but not necessarily good enough to support market performance. How have you been viewing earnings season so far?
Yeah, the US bank season started very strongly, particularly for those with big investment banks. Strong on trading. You've seen a lot of banks see their Asia trading revenues go up materially. And that's related to this AI trade. Everything seems to come back to this AI trade. And then on the other side, you've obviously seen a lot of ECM and DCM work. So with these hyperscalers going from sort of buying back lots of shares now to even issuing shares to finance their CapEx bills, but also doing a lot of debt issuance as well. And so investment bankers have been very busy making lots of fees from that activity. And then the final part of it where they've been making lots of money is obviously on IPO market. So we saw the blockbuster IPO of SpaceX, and we're expected to see maybe a couple more big IPOs through the rest of the year. And then I think the other interesting thing about banks actually is on the consumer level. So we've talked about K-shaped economy a lot, I think, over the last 18 months or so. But actually we're seeing the bottom of that case start to improve. And there's a lot of evidence that consumer is reasonably strong in America as well. So that's good to see. And then absolutely on the semi side, really huge numbers from TSMC and ASML. They are seeing demand far outstripping what they can supply. They both announced big capex increases. But ultimately, the market is sort of sitting on the fence, if anything, perhaps slightly cautious, and that's because they've just run so hard this year. Valuations are looking a little bit stretched. I think the market's waiting for the rest of earnings season to get a really good steer on, okay, what's the next leg of this trade? Because the risk is that hyperscalers are spending so much money, but ultimately they've got to make a return on capital. And if that return starts to look a little bit meager, then the risk is that they start to walk back a little bit. And then the whole trade could unravel quite quickly, just as you're seeing a lot of semi-names announce a big capex increase, and that really could make for a nasty turn. But I don't think we're there yet, to be absolutely clear. I don't think we're there yet. I think we will see some very strong numbers over this earnings season for the semis names, but that thought will linger in the back of people's mind for the next few months.
Definitely. And it takes me back to a point that Sam Witherow made last week on the Pout, where he was basically saying, look, we know the semis are going to be really strong. It's exactly what we've got so far, but pointing to the hyperscalers needing to demonstrate that that capex increase is still ongoing to then support the revenue forecast for the semiconductor names. Now, let's get into this week. We are awaiting Andy Burnham's arrival at Buckingham Palace. He's off to see the King today to be asked to form a new government. I guess big picture, first of all, it's been a pretty choppy ride, I think it's fair to say, in terms of UK politics over, 10 years, dare I say, not just the past few quarters. For a UK equity portfolio manager, set the scene. How much attention do you pay to this?
Yeah, there was a very interesting chart in a Bloomberg article that I read the other day where it had all the prime ministers going back to Tony Blair and how their popularity had evolved over their tenure. And history would strongly suggest that Andy Burnham is probably about as popular right now as he's going to be. Because unfortunately, we just see persistent decline in popularity over term. And it reminded me of a great quote from Tony Blair, where he said, you start at your most popular and least capable, and you end at your most capable and least popular. So he's got a tricky time ahead of him. For us, though, I think UK politics is important. We do consider it, and we try to bear it in mind, but it's not the be-all and end-all. First thing to say is that UK equity market is incredibly international. So about 20% of revenues come from the UK economy, and then about 80% of revenues come from overseas. So it really is a very diverse market. I think the biggest impact that Burnham could have would be to get the bond market under control. And that's probably the trickiest task. And there's little evidence from policy that they're really going to get to grips with this. But it's a huge burden fiscally. The UK spends about £110 billion per annum on debt service cost. And that filters through as well to the cost of capital for so many things. And when you drive up the cost of capital, you really put a handbrake on economic dynamism. So I do think that would be key. And then on the other hand, you'll see announcements of policy which have specific impacts on certain sectors. So things like contractors, home building, those big popular things to address. I think you'll see some discussion points there.
Definitely. So let's get into some of those sector specifics and really into the weeds. You mentioned this 80-20 split for UK revenues. I want to start with the 20% and some of the domestically focused names. So for your companies that you're following who are especially exposed to the UK consumer, what do you like? What do you don't like? What do you see going on at the moment?
Yeah, so we still like contractors.
Just to stop, what do you mean by a contractor?
So outsourcers, basically where there's big jobs that are tricky for the government to do themselves, and so they effectively outsource that through competitive bidding. However, it's often viewed quite negatively in the press, and I think it's quite a popular target for politicians to say, we're going to do less outsourcing because we're spending so much money on them. But the reality is that often they're spending lots of money on them, but if they bought them in-house, they'd possibly be spending even more money and doing them less efficiently. And I think when you're not in power, it's easy to say they're a target. Like many things, when you come into power, the realities are a bit more tricky. And so perhaps they'll review that sort of talk of doing less outsourcing and decide that perhaps that's not the best thing to do. So we still like those companies because we actually still see quite a lot of work, and some of them have good exposure to sectors like defence, where you're seeing a lot of growth. I think the other very popular area for politicians to talk a lot about is home building. One of the UK's trickiest problems to solve, perhaps a huge undersupply in the market, but really how do you stimulate that building? And it's proved incredibly difficult for many, many governments. There's been lots of policy support like Help to Buy, but the reality is you need interest rates to be lower. So coming back to that gilt problem I mentioned earlier, and you need to stimulate the buying, and you could probably do with doing something with stamp duty as well.
I mean, this is a pretty common theme, I think it's fair to say, that you get a new UK Prime Minister and they commit to building lots more homes because we know the problems that's causing. Sounds like what you're saying is that your expectation of a huge ramp up in home building is pretty low. Is that fair?
That would be fair to say, yeah.
Yeah.
Again, it's one of those problems. I think you look externally and you say, well, we could do this, we could make it easier on the planning side, we could come up with some sort of policy to stimulate demand and encourage supply. But the realities of it are that there's a lot of pushback on building development. Anyone that's been involved in trying to have something as simple as an extension in a house will probably know how difficult it is to get planning. Well, imagine trying to build a huge greenfield site. It's incredibly complicated. And the other thing is that regulation on house builders as well. The standard of home that needs to be built now is very expensive and requires lots of back and forth between you and the council. And therefore, it's very hard to bring huge amounts of home to the market. And put on top of that, where interest rates are now, mortgage availability, mortgage cost, it really makes for a tricky concoction.
You mentioned interest rates there. Obviously, for the banks, this is going to be another area of focus in terms of what a new premiership means for UK financial policy. How are you seeing the financial sector at the moment?
Yeah, I think whenever we get a new government, people worry that there might be an increase in the banks levy, and that may come through. But for us, we find banks still very attractive. So there's a combination of the valuation is still pretty reasonable to us. So they trade on sort of premiums to book, but not vast ones. The quality, I think, is quite high at the moment in the bank sector. They're generating returns on tangible equity in the teens, sometimes high teens or low 20s, and their balance sheets are in good shape. There's been minimal provisions, even through various shocks you've seen in recent years. It's been very steady. So I think they've really improved the quality of their balance sheets. And that means that all that profit that they're generating, they're able to return that capital back to shareholders. So you're seeing huge share buybacks, very attractive dividends as well. And then things like the structural hedge, which effectively smooth out the benefit of interest rates over multiple years, mean we have good visibility. And we actually have pretty good loan growth as well at the moment in the UK, sort of nearly 5%. So you put all of that together and you've got very high returns on capital. We've got a bit of growth and a valuation which we don't think reflects those fundamentals.
Worth noting here as well, we have UK labour market data coming out tomorrow on Tuesday and then inflation on Wednesday. So for me, I think of those two, the labour market probably more significant this week in terms of setting the direction for the Bank of England, given the ongoing weakness that we see there. Then, Callum, I think turning to slightly broader perspective here, change in leadership for domestic investors, we've all known that this has been coming for a long time. For international investors, I think the phone's starting to ring again, at least on our side, with people asking, okay, is this a significant change in direction for the UK economy or not? From your perspective, how do you see the demand for UK assets from outside of the UK?
Yeah, I think it's sort of slightly ironic that the international investor is quite positive on UK assets. And I think, they're not marred so much by constant negative press, and they can take a fairly objective view on valuations. So you've seen loads of M&A over the last few years. We saw Rotork last week at a 75% premium. So not just usual 30, 40%. Huge premiums reflecting how cheap some UK assets are. I think over the last 12 months, about 9% of the FTSE 250 has been taken out.
9%?
So 9%. So absolutely massive amounts of M&A. And that just tells you a lot of overseas investors are thinking, wow, these are incredibly cheap assets. And then from a broader perspective, international ownership of the UK market has gone from about 30, 35% in the 2000s through to more like 60% today. So while domestic asset owners have been selling pretty consistently, international buyers have taken that up. And I think that reflects on the valuation opportunity from a more objective perspective.
No, that's nicely put, and maybe an optimistic way for us to bring that UK section to a close. So just to round off today, looking ahead to this week, lots of data out. I mentioned the UK data. We also have flash PMIs for July, the business surveys due at the end of the week. But the ECB meeting for me is probably the most interesting event from a macro perspective. They meet on Thursday. Not much expected in terms of changes to interest rates at this meeting, but for me, this is all about how they tee up a potential next move in September, which is pretty close to fully priced in the bond market today. With this in mind, Callum, I mean, in my team, we've been thinking about the ECB actually having a little bit more room to be patient and therefore expecting some steeper yield curves in the Eurozone over the coming quarters. A word on European banks in some of the global strategies that you do run?
Yeah, I'd say as well, just to preempt that with what's going on in Iran, I think they'll feel even more like they need to put rates up. A lot of the things I said about UK banks apply to the European banks as well. And so that higher for longer environment just means more profitability as long as we don't see a serious economic situation. So we are positive.
Perfect. Like it. So in terms of what we've covered today, I think big picture macro last week, it's all about this tug of war. Obviously, oil markets are making the macro outlook worse, frankly, relative to a week ago with oil back above $90 a barrel, but earnings are off to a very strong start. Not good enough to support share prices everywhere, but certainly the numbers that we're seeing coming through look very strong. On the UK, good luck to Mr. Burnham as he takes office today. It looks like a pretty tough job, we must admit, but some of the sectors you highlighted there around the home builders, the contractors, the financials, bluntly, it sounds like this is largely business as usual in your portfolios without seeing major changes as a result of a different leadership. And then on the ECB, no change expected this week, but all eyes on how they tee up a potential next move later in the summer. Callum, thanks a lot for joining. I've really enjoyed this morning's conversation. Good luck this week. And to our listeners, we will see you back next week on Monday.
Thank you.
This communication is educational in nature and not designed to be taken as advice or a recommendation to buy or sell any investment or interest thereto. It is based on assumptions in current market conditions and are subject to change. It should be noted that the value of investments and the income from them may fluctuate in accordance with market conditions, and investors may not get back the full amount invested. Past performance, yield, or forecasts are not a reliable indicator of current and future results. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.